One of the first things I think that's really important for companies and founders to have in place is their cap table.
Helping us today, we have Rajiv Samani, who's a corporate solicitor at Joelson. They're a founder-centric legal firm that have helped many of the people within our network. They're our exclusive legal partners, and we can't thank them enough for backing us. We're the Bay HQ, and I'm Amma, and this podcast is powered by HSBC Innovation Banking. I hope you enjoy. So Rajiv, really great to have you on today. We've obviously quite good friends, been able to chat with you quite a lot, and I know this is something you're really passionate about. So let's dive into it at the beginning. So a lot of people try to raise their first round who obviously don't have a clue what they're doing, right? And they might go to different platforms where it can make some bits easier, but they don't really understand what's going on. So in your opinion, professionally, what should people be thinking about before they start doing their first raise? Like, what do they need to have in order?
That's a really good question and a great place to start. So thanks, Omar. One of the first things I think that's really important for companies and founders to have in place is their cap table. It's a starting point, really. Investors will really want to make sure that the way things are currently set, especially if you've taken on family and friends investment, and you're looking at your first seed raise, pre-seed raise, or even looking at institutional investment, that you've got everything in order. What you say has happened in the past has happened, and it's easy for them to see what will happen sort of pre their money coming in and what will happen after their money in terms of their equity rights, whether there are any share options in place. I think a good cap table can really work well for a company going forwards. And it's something that if you have that in place early on, it'll help your company be very succinct and to the point from an investor point of view. It'll attract less diligence, which will incur less cost and less thinking time at your end if you have it earlier on in place. So that's really important. Another thing that we'd suggest from a legal perspective is to have your what's called statutory registers in place. So simply put, these are your company books that should be held by yourself or your accountants, for example, whether that be what's called your register of members. So who's a shareholder in a company currently, whether it's yourself and your co-founder only, or any, as I said, family or friends investment, or register of directors. So who's a director of the company. And you can tie this in quite nicely with any employees of the company as well and have that all in one place. These are all things from our point of view that founders should have in place. So any investors, when coming in, can see everything in one place and show that your house is in good order.
So one thing that happens, right, is when, especially from Asians, right, often it will be family members or their uncle or whatever it is has given them a bit of money to help start it off. If it's been that quite informal, where it's just been, oh, he's just going to give me a bit of money to start it off, how do you go about that formalization process? Is it something which people can do by themselves, or is it something which they really need outside help to do properly?
That's a question that I get quite commonly, because what you'll find is that to yourself, you think, okay, it's just my uncle giving me a bit of money. I don't need to document this or put this on paper. But you have to always think with a view to, you're going to sell your business for £500 million in 10 years' time. Does everything that you said stack up in terms of paper? Remember, a buyer or an investor won't necessarily know that that's the relationship you have with that individual at the time. Things can change over time. So we don't think at that point, say, for example, there, your uncle's giving you 10K, you don't need to engage a solicitor to put together a loan agreement per se, but having it documented, having it written down in the form of a board minute, a simple board minute to say, on this date, I was given this, there's no interest, things that are important to the future. And if it has been repaid, making it clear. If you have an accountant or someone who advises you in that extent, sort of knowing that everything is, as you say, you need some evidence. So it hasn't got to necessarily be, okay, we've engaged a solicitor to put together a loan agreement to show that this is what's happened. Obviously, that doesn't necessarily be proportionate to the amount of money put in or the relationship, but it's important to have some things written down in some way for the DD process for any investor going forward.
So obviously there's the horror stories of where somebody's come back 5 years later and be like, oh, I own 10% of the company. And because it hasn't been properly documented, then all of those problems come about, right? But if we dive a bit deeper into some of this documentation, so a lot of people have heard of the term sheet, right? And when you first start to look for investors, that's where you really start to hear about term sheets. But for most of us, we never heard about that the entire life beforehand. And now all you just know is the term sheet is really important, but you don't really know what to do about it or what exactly it is. So explain to us, like we're 5 years old, what is a term sheet? What is the anatomy of a term sheet?
So first things first, so the first confusing thing is there are different words of ways of describing it. So you often see heads of terms, term sheets. So they're fundamentally the same thing. The way I would describe it most simply is that when you're a founder, you often have your pitch deck, right? And that's what you give to investors and say, this is the commercial reason why you should invest into my company, my baby, essentially. But what a term sheet does is that sort of actually the financial proposition and what rights they get as being an investor, and also what rights you maintain as a founder or the other shareholders maintain. So going into the anatomy of a term sheet, it covers some stuff as simple as, for the investor coming in, what information rights do they get? Do they get a position on your board? Are they simply someone who gets to observe and see what's going on, or do they have an active role? What class of share do they get? Are they the same as all existing shareholders? Do they get extra rights when it comes to a sale? Where would their shares rank if there was less money than you'd hope in the business? Stuff like, if you were looking at a sale down the line, what percentage of shareholders is needed to bring that sale to fruition? Are they part of that? And often one thing that we see most negotiated, and it's important to go into detail in a term sheet, is to do with what's called consent matters. So does that investor, when they're coming in, is their consent needed for any particular matters that the company is going to do in the future? For example, stuff we commonly see is entering into a commercial contract above a set value, hiring a senior executive, issuing new shares. That's the one that I'll come back to that going forward, that having a blocker on issuing new shares or needing an investor's consent to issuing new shares is a real red flag for a founder, because and I'll go into something else called preemption rights, which is the ability to match and be involved in a future investment round as an existing shareholder. That's very market for investors, and we'd expect that to be the case for most investments. But what you don't want is to have to ask a new investor's consent every time you want to raise money. We want to stop things ever being a blocker for you as a founder. So even simple stuff like setting out, this is the existing cap table, this is the existing shareholding, this is what happens right now before your investment, this is the situation with equity after your investment. A term sheet will also deal with what's called leaver provisions. So right now, obviously, as a founder or co-founders, you're all employed with the company, everything's all great. There might be a situation where someone leaves. Do they retain their shareholding? What defines a different kind of leaver situation? So there are so many different provisions. And going back to the first point you made, if you're given a term sheet, you're on a bit more of a back foot because you're not actually in control of what's put together there. Whereas if you can present a term sheet alongside your pitch deck, for example, you're saying this is the commercial proposition and this is the financial proposition. Take both together and see what you think about the business.
So it's really interesting there from the outside. I always wondered, why do people get different types of shares in the first place? What's the reasoning behind why you would be even willing to consider that at all? So you think, from the outside, you think everyone's shares are the same. But obviously, that's not the case in reality.
No, that's a good question. I think it's actually sometimes not looked at in enough detail because it's always to do with a future event, right? It's sometimes shares are given to different investors because some shares have dividend rights, some shares have voting rights. But when everyone gets a vote, it's often the case where shares are of different classes because of what's called a liquidation preference. In the event of an insolvency, there is a priority order in which money is paid back to different share classes. So often what you'll see that this share is at the top of a liquidation preference. And you often see institutional investors, VCs, ask for a share class that's at the top above everything else, because if they're envisioning that the investment does have an element of risk to it, they want to be receiving their money back first before everyone else, as well as dividends and other voting rights and stuff like that. So that's the reason behind there being different share classes.
So how much power does a founder have to negotiate with these kinds of groups, right? Because often I know many founders are quite scared to negotiate with a VC or an institutional investor because they feel like they're the small fish and the VC has got so much power.
So that's something that we commonly see, and it's something that we do try to fight back, because as a very founder-led firm and someone who fights for the key important things for founders, when we're onboarding a new client or having a first discussion, we often hear from founders things along the lines of, well, we want to fight for the important things, but we don't want to upset the investor, or we're worried that if we fight for too much, they'll walk away. So we want to dispel that myth, because while we don't fight for the nitty-gritty, pedantic legal points, you have to understand that, and from an investor's point of view, in fact, more commonly, that they're expecting negotiation, and that they will have a baseline bottom point where there will be things that they won't accept a pushback on. But there's a lot of things that have leniency, and often investors and lawyers who act for investors will have a very blanket approach not very tailored to the business that they're actually investing in, and say these are the list of things that we require consent over, things that might not even be applicable with regard to properties or contracts that aren't in place or data protection, things that might not even be relevant, but it's just a very blanket approach. So we want to make sure that what's actually there and what's in the term sheet is actually specific for the business and things that you can actually act on. We see cases where there are various conditions to completion, so things that a founder has to do before, whether it's various insurances in place, a D&O insurance, key man insurance. These are things that aren't too tricky to obtain, but they might not be relevant to a particular business. So it's just something where, can you actually do what you're being asked to do? And is it something where you feel that there's actually a more middle ground, often to do with timescales and making sure things are in place by a certain time? So we often really do fight for a founder and get them to realize that there are things you can push back on. Just because you push back doesn't mean the investment will fall away. It's all part of a negotiation, and it's important to understand these concepts because some of them are quite tricky and some of them are there's lots of detail in the drafting that you need to understand that actually works. So again, another reason why it's important to engage lawyers when you're definitely negotiating with institutional investors who are very, very au fait with the key provisions that are quite technical.
So what's interesting there as well, I think, if you're investing in somebody, but in some ways you're expecting them to take a crappy deal, that goes counter to who you're investing in, right? As in, if somebody's showing that they're taking the initiative, they're looking at the points, they're looking at the different details of that contract, I say it's actually a good sign to an investor, because you want to invest in kind of person who does that, right?
That's definitely along the lines of, I'd echo that, as someone who looks at investing themselves, or generally if you know people who do invest, you almost don't expect the process to be smooth because you want there to be some level of negotiation. As you said, in the future they're going to be doing the same process with another investor. So totally agree with you.
Yeah, like if you can walk over them, then it's likely that other investors will also walk over them, which is bad for you. And another point that I know that's really sticky for so many people, and they really struggle with, is that valuation aspect, right? Of when they're asking investors for their first institutional round, how do you price something? Because some of these companies won't even have revenue yet, so you can't do a price like a revenue multiplier. And then for others, they'll think, oh, we're going to get to 100 million revenue in 2 years, so we're going to put our price at 50 million valuation, but we've got 2 customers. And how do you advise people on that? Because I'm guessing lots of your customers will also come to you for that.
Definitely. So we get a lot of questions about valuation, and in particular, do you think we've got a fair valuation here? Do you think we should be lowered? And to be honest, we're not able to properly advise on that, but we can take a commercial view and say, to be honest, an investment that's coming in, if you have a number of smart angel investors or individual investors who know what they're doing, if they're all happy to invest at the current price, that means your valuation is pretty spot on. There is no sweet science to it, especially for an early stage business, because as you said, there's not historical years of revenue or contracts in place. Often you are investing in the individual and the idea. And one thing we say from a legal perspective that's important is that you don't want to pitch your valuation too high. I know everyone is conscious of giving away too much equity in a business, and that does often affect the valuation and the threshold that's given. But what you don't want to do is set yourself a really high valuation and then say you need more money in 6 months' time and you're planning another investment round, then having to invest and receive investment on a lower price. That's what's called a down round. And again, it's all with a long-term view. You don't want to set your sights too high. You want to be positive and obviously have reasoning behind that. But there is no science. There's not always metrics that can suggest what the right valuation is. But we'd always take the approach of saying that if you've got a number of investors that are all happy with the price, you're pretty much there.
We hope you're enjoying the episode so far. We just want to give a quick shout out to our headline partners, HSBC Innovation Banking. One of the biggest challenges for so many startups is finding the right bank to support them. Because you might start off and try to use a traditional bank, but they don't understand what you're doing. You're just talking to an AI assistant, or you're talking to somebody who doesn't really understand what it is you're even trying to do. HSBC have got the team that are built out over years to make sure they understand what you're doing, they've got the deep sector expertise, and they can help connect you with the right people to make your dreams come true. So if you want to learn more, check out hsbcinnovationbanking.com.
So we touched on this earlier as well, and you said about different types of investors. If your angel's all on board, then your valuation is probably decent. But how do you think about it when you're dealing with different types of investors? So whether it's VCs, crowdfunding, your mate down the pub, how do you deal with the legal situation in those different environments? Can you use a one-size-fits-all approach, or does it have to be tailored?
There are different forms of legal documentation that can mean that you can often take investment in at one date and then fix the price down the line. These are called ASAs, advanced subscription agreements. So that's definitely something that we'd advise, and we do a lot of work in that space, helping founders who aren't 100% concrete on their investment price. And to be honest, what they want to do is get the money they've secured in right now to help the business grow, and then there might be a 2x price in 6 months' time, and then for investors, they're given the benefit of a discount for taking that risk and investing early before there's a price at hand. But the one thing you want to be careful, and it's almost a Dragon's Den style situation where you say your uncle came in and he gave you 10K, and you said, "Oh, thanks so much, uncle. For that, I'll give you 25% of my business." So in theory, you're rallying your business there at 40K. But then 6 months down the line, your business is doing really well, and someone comes in and they're giving you £250,000, and you're saying, "We'll give you 5%." And they're saying, "How can it be this at this stage and this at this stage?" So you have to be very careful with the early stage giving up equity because you need a bit of money earlier on. There are very different ways to go about it, to make sure, as I said, going back to the first point we discussed, what's important to get in order, your cap table. If you can look at your cap table clearly and say, this is how much this person's got for this amount of equity, you can see that you don't want to dilute yourself too much. So it's important to take a fairly uniform approach, and to make sure that you're not giving someone for the sake of family and friends, or someone because there's a goodwill involved, a better price, when actually an investor who's institutional and knows the market well won't accept that on the basis of you just did it at the time because it was for a friend or something like that. And as you said, that's that kind of friends and family situation that you often see as the first raise. It's important to follow as legally formal an approach as possible.
You mentioned ASAs there, and I've done a couple of investments myself with the ASAs. But I assume a lot of people, when they first start to raise, they don't really even know what that is. So you've met a traditional model, you think, okay, people do their soft commitments, you get to the amount you said, and now everybody who's soft committed, you then collect that money, right? But that's not the way it always works. And ASAs, like you said, you get the money in advance. Could you go into a bit more detail about what exactly happens there, and whether or not it's a good idea for people to do ASAs, or if it's actually legally maybe something that's more complicated that they should be careful about?
It's different. So if we go back to the first point about a term sheet, if you were doing a simple equity fundraise where you've got an investment agreement, which is the long form document behind a fundraise, you'd have a term sheet going through a lot of these points. If you were to go down a different route, where like an ASA, which is something where it's more what's called like a convertible loan, is another example. It's documents where you're getting money into the company, but you aren't giving shares straight away. So the price is dictated in the future, and what's happening is essentially a loan that a future investor is putting in for shares in the future, but they're putting the money in right now. And there are lots of benefits to this because, as you say, you don't know necessarily what the price is going to be right now, but also it ties down to future events of the company. It's essentially investors taking even more of a punt and realizing that this is a risky investment, but we want to help the founder grow, and we're happy to realize our equity in the future. So going into a bit more detail about ASAs, there are often a number of events that what's called conversion events or trigger events, which make sort of the equity turn live, whether that's a particular date. Say we've entered into an ASA today, you might say that a long stop date or a conversion date is 2 years to this day. Or earlier, for example, if there is another equity fundraising, another fundraise of, say, a certain threshold, say £1 million, then your shares will become live at that point. Or if there is a sale of a certain amount of the company, your shares then become part of that sale. So it's quite a neat document, especially when you don't know what price exactly you want to fix your valuation at. And it means that you can essentially bank money that you currently have and essentially take on loans from investors who are happy to realize their equity in the future.
So before we go into quick fire questions, I know that you see a lot of situations of where people try to fudge the legal stuff themselves in the early days. Maybe they even get through their first fundraise doing it in a patchwork way. What are the biggest mistakes you see there that sometimes you have to come in and later fix? And you just wish that people listening right now didn't make those mistakes. What are some of the biggest mistakes you see people make that hopefully you can save them from them listening to this episode?
So firstly, I mean, we as a law firm which acts with a lot of founders, and we start with founders who are taking on even very small amounts of investment. We sympathize with the fact that obviously engaging with a law firm does cost money. And money now compared to the value of the investment, it's not always the most practical or efficient thing to engage solicitors. But there is obviously a huge benefit. And the way I describe it is that you're going to have to do more work in the future if you don't engage legal advisors early. And by doing that, it just makes sure that your house is in order. So we often see founders use other document generation platforms to help them produce a suite of legal documents they can send off to investors. And to be honest, that's really good. And it almost is the best solution for really early stage businesses who are just looking to have documents in place. But when it comes to negotiating with institutional investors, you need to have a more robust suite of documents that actually cover your interests. So we've seen issues in the past where it's not always to do with equity necessarily and to do with giving up a certain amount of equity, but it's to do with consent rights and to do with things that actually, as a founder, you didn't realize you're actually signing up to needing an investor's consent every time you want to raise money, every time you want to hire a new employee, every time you want to get rid of someone in the company at all, no matter what their threshold of salary is or how important they are to the business. Whenever you want to take on any debt, whether that even be a short intercompany loan or give money back into the company. So there are so many actions that you'd think, okay, in practice, I won't need to worry about this. But you have to remember, if an investor's coming in to take 10% of equity in your business, the rights they have over the business and the consent rights, they should match that 10% and not be sort of almost what you'd expect yourself as a sole founder to have. So it's little things like that. And I think these points are really important because every time you build up a set of legal documents or a term sheet, if you're looking with a view to the future, you're always going to get investors who are going to look back to the previous term sheet and want to see that, or previous investment, previous long form document. And if there are things that seem to be not in place as they should, they're not going to agree to changing that if it's not in their favor. So everything is with a view to the future.
Awesome. So thanks so much for coming on today. Is there anything else you want to bring up just before we go into the quick questions that you think you'd love for founders to know?
To be honest, I think we've covered quite a lot of points. I think one thing, and this is just more from my experience and experience of working with some really, really technically gifted lawyers who also are very commercial, there are a few different points that can be quite good tricks and hacks to look at as a founder. Often, if you're looking at institutional investors, they'll want a director on the board of the company because they want to see all the information that how the company's doing, so they can pass that on to their investment committee, etc. But also there are some typically angel investors who aren't too fussed with that. They might present that as their first option, but often you can get away with as a founder of offering what's called a board observer right. So angels get to see what's going on with the directors in the company, but they're not actually involved in the voting process. And that can often be because they often have 10, 20, 30, 40 more angel investments. They're not necessarily considering being involved in the management of each of these companies. What they want is just the information that they can sort of see how their portfolio investments is going. So that's something that's quite important because remember, if you give someone a director right, they're on the board, and in the future, the balance of the control of your board is very important for voting and all these decisions that we refer to. As much as we say there are matters that require investor consent, there are also matters that require the board's consent, which is pretty much all matters under the Companies Act. So you want to make sure the balance of favor is always in favor of the founders and the company over any investors. So that's an important point. And I think other things considered, you're always going to look from a legal perspective at things that are at the present, right? You're saying, I'm an employee of the company as well as a director and a founder, and things are great. I don't see myself leaving. This is my baby. I would never leave unless we're selling. But you need to make sure that you're protecting yourself in the future. And there's the thing that we see called good leaver and bad leaver provisions. And these are some of the most technically tricky areas of drafting when it comes to an investment. And often institutional investors will have pretty strong views about what determines a good leaver and a bad leaver. And the reason why this is important is because you own your class of shares and you expect to receive money in return for those shares. However, if you're what's deemed to be a bad leaver, which normally is someone who's done something that's misconduct or broke their restricted covenants, etc., stuff like that, or done something that's against the Companies Act or got disqualified, that's what would be a bad leaver. And that's how it would commonly be drafted if you're acting for a founder. However, what investors often do is they try to define what a good leaver is. So what someone who's actually left and will receive the reward of all their shares, and then say everything else is a bad leaver, which is a massive catch-all, which is actually quite tricky, because then you're basically saying if you've not done one of these few things, you're not a good leaver. Therefore, by virtue, you're a bad leaver. And we see that often. Then you think, just reading it from layman's terms, I'm not going to be a bad leaver. I'm the founder of this business. I would never be a bad leaver. I never want to leave. But actually what you need to realize is that you need to make it the other way around. You need to say, this is what a bad leaver is, and everything else is a good leaver. So as long as I don't do that, I'm a good leaver. And it all goes down to receiving the rights to your shares in the future. Because if you're a bad leaver, then you might have started the business, got all these investors on board, provided all this value, but then you then lose the right of your shares as you leave, as opposed to a good leaver who receives the value of their shares. So this is a really tricky area of drafting, which we often see people just sort of tick a box and say, okay, it's not going to affect me. In a term sheet, you'd often see standard good leaver, standard bad leaver provisions. You should never accept that if you're a founder. You want to see the detail in a term sheet, because otherwise what will happen is that what we're seeing investors do more and more nowadays is try to align themselves with what's called the BVCA documents. This is the British Venture Capital Association documents. This is a great suite of template documents for investors and founders, and we often see them used as a template for drafting long-form documents. However, the caveat to that is they are inherently known in the market as being quite investor-friendly. So if you're a founder, you don't want to accept standard BVCA wording around good leaver, bad leaver, because that will include some of the provisions that I've said earlier on, which aren't in your favor. So with those particular areas that are quite technical, it's important to take advice. And I think that just understanding the concepts is one thing and talking to someone who knows about them, but also when it gets to that stage and there are a couple of institutional investors looking to invest in your company, you do need to take legal advice.
Awesome. So thanks so much for sharing that. We're going to move into quick fire questions now. So first one is, who are 3 British Asians you think are doing incredible work they love to spotlight and the audience should be paying attention to?
Definitely. So number one, I mean, firstly, this is quite hard because there are a lot of people in my life who have influenced me, but also people who I think are doing really well now or in the past. But these 3, I think, have definitely shone a light in terms of people who I look up to and also who are doing great work in the British Asian entrepreneur sector. So the first is a chap called Atul Lakhani, who's the CEO of Sanjay Foods. I mean, Sanjay Foods is a fantastic business generated in Leicester. It's a food hospitality business, specializing not just primarily, but in some really luxury, top high-end corporate events, having catered the Downing Street Diwali party, for example. But also they do a lot of weddings and have a great venue in near Coventry. So that's a business that's come from sort of nowhere to being a family-run restaurant to being a big corporate hospitality business specializing in food catering. And I think they're doing really good things, hiring a lot of staff and just generally promoting British Asians. So that's a really good business that I want to shout out. Secondly is a chap called Sailor Stakra, who's an entrepreneur, a British Asian entrepreneur for a company called Dallas Holdings. So they're the approved franchise partner of Pret a Manger. So they've franchised Pret across Europe, across the UK and the Midlands, and even further north and south, away from just there being a Pret every 5 minutes in London, and also recently launching in the US, both east side and west side. So again, they've taken their previous holdings business, which is involved in sort of petrol stations, coffee shops and services, and then working with Pret as a franchise partner, and they're doing really, really well globally. So we'd love to give them a shout out. And then a chap called Paresh Pal, who's the CEO of TechnoWorld. So TechnoWorld is a leading supplier of laptops and PCs. And again, this is another family-run business that started from nothing 20, 25 years ago and is now a leading supplier in the UK. It's a great story of sort of a business that you don't necessarily think you'd fall into, but a simple business where you receive product and you put it together and you retail it out, and it can show that ideas come in all different forms. And it's sort of to see someone start from a young age and see it pass into the family. And there's 3 sons are now involved in the business as well. It's great to see a family-run business, and I think that really matches the ethos of British Asians generally, looking after your family and also keeping family heritage together. So those are my 3 shout-outs.
Awesome. It all sound great. So next one is, how can people find out more about you, find out more about Joelson?
So people can find out more about me. I mean, I'm all over LinkedIn. I post quite a lot, not as much as you, Amar, but I do post a good amount. So my details are all on LinkedIn. I'm happy to have a chat and speak generally. Of course, I'm all across Joelson's website as well. But just generally speaking, you can always drop me a message on LinkedIn. Always say, let's have a quick chat to discuss this and that. At Joelson's, we're quite big on social media because a lot of our clients started off reaching out to us in these platforms recently and in the past as well. So across social media, you can my details are all over my LinkedIn. So yeah, feel free to always drop me a message. No question is silly. Always have to have a chat.
Then is there anything that the audience could help you with? that you're looking for help with right now?
So I suppose one of the things that's really exciting about Joelson is that I think last August or September, we became B Corp accredited, which is we're already the fourth law firm in the UK to become B Corp accredited. And since then, there have been 4 or 5 more firms joining in, being UK-based law firms who are B Corp accredited, which is exciting and great. B Corp accredited, what it means is that your focus, as well as being an entity which drives for profit, and is also one that helps the planet at the same time, and it's not either or. So we're really looking to knowledge share and understand from other B Corp businesses sort of what they're doing to get even better, how they can look to sort of really help this net carbon environment that we're looking to pursue, and generally help us make our processes more ESG friendly. So a lot of our clients are now going on this path if they're not already. So I'm really personally interested in someone who's involved in that in the company, to see who can sort of knowledge share and explain what they're doing to make their company as B Corp friendly as possible.
So thanks again so much for coming on, Rajiv. Any final words?
No, nothing from me. I think it's been great to chat. I think just a shout out, obviously, myself and Joelson, we're the exclusive legal partners of the BAE. We've loved working with you guys. I think you don't get enough shout out yourself for all the great work you're doing. These podcasts wouldn't be able to happen if it wasn't for all the hard work that you put in, Amar, and also Gabby as well, doing so much stuff in terms of having lots of introductory calls, angel investment discussions, making sure that everyone is heard and everyone has had time for each other. I think the work you guys are doing, I think you'd be my 4th shout out. So yeah, I think thank you for putting everything like this together and making all of us have a voice like you do.
Thank you for watching. Don't forget to subscribe. See you next time.